Mortgage workouts is the title of this message. Mortgage workouts are the way that we refer to a variety of solutions that homeowners and lenders are using to deal with the housing downturn. Workouts include refinance, mortgage mods, repayment plans, forbearance, deferments, deed-in-lieu, short sale, and foreclosure. Whew. With all these options, you'd think we'd be moving more quickly towards stabilization, no? Well, since they are all extremely costly, every party involved is slow to take the medicine. Here's an update on each of those methods. First of all, refinance. As the housing bubble inflated, it was periodic refinancing to take equity out that kind of contributed to the pain that many of us now feel as the bubble has rapidly deflated. Today, refinance actually is less, the number of refis is less because values have fallen so low. For the fortunate ones who still have considerable equity in their homes, refinancing to a lower rate can be a great value. It's predicted that interest rates will remain low for an extended period, so activity in this area should continue for some time. President Obama's Housing Assistance Program encourages the use of refis to help homeowners who are only very slightly underwater on their mortgages. Now, mortgage modifications. This is the hot workout for 2009, and it's expected that there may be over 2 million of them during the year. Initially, modifications were limited to interest rate adjustments only, and they were short, like for a 3 to 5 year time frame. But as the crisis has deepened and as bailout money is spent, we see more and more use of principal reductions, length of loan extensions, and even lower interest rate mods. President Obama and virtually all of his HUD executives have endorsed modifications as the primary weapon in their fight to slow the rate of foreclosures and provide some stability to housing prices. Now, if you want to consider modified loans versus refinance, really hands down, mortgage mods are better for the consumer because there's no broker fee, no application fee, no points, no appraisal fee, no escrow fees, no title fees. So it's really considerably faster and considerably less expensive than a refinance. And they're completed virtually in the same amount of time, I guess 30 to 45 days. Now let's move on to repayment plans. Now, if a borrower only needs temporary relief from a short-lived financial hardship, these plans are best. The lenders are quick to agree to them as they really are revenue and profit neutral to them. They simply add the arrears to the note and require a 3 to 4 month on-time payment to restore the loan to a current status. These plans are also often used in conjunction with mortgage mods, especially if a borrower is 90 days late on payments already. The lender may require a 3 to 4 payments to be met before granting the modification. Now, forbearance. These are commonly used for temporary financial hardships that are foreseen, such as short-lived periods of unemployment or health issues. In the simplest of terms, mortgage forbearance enables you to temporarily stop making your mortgage payments. Interest continues to accumulate on the mortgage forbearance, and it's added to the remaining balance of the loan. Generally, you're asked to sign a forbearance agreement that states when the lender will require you to pay the amount you owe. Once the forbearance period comes to an end, you are once again obligated to make full payments on your home loan. While mortgage forbearance may only serve as a temporary fix, it does buy you some time to overcome near-term hurdles and can avoid the credit rating damage of default. Now, deed-in-lieu. This practice was much more common at the beginning of the housing decline. It's the free transfer of your title of the property from you, the borrower, homeowner, to the lender. The lenders were willing to accept the property in lieu of foreclosure when values were closer to the amount owed. They would simply assign the property to one of their agents, and the net amount that they got from the sale of it went to pay off the loan. But now, as values are so low, it has become only rarely used. It's an easy and a great solution for homeowners who have given up kind of on retaining their home. The lender reports the loan as paid as agreed to the credit bureaus, so it can be a good solution. Short sales. This workout enjoyed a prominent place in foreclosures in 2007 and 2008. It's the practice of selling the home for less than is owed, the lender authorizing the sale by approving a short payoff of the mortgage. This process is now being used somewhat less often as it is massively expensive, and it puts people out of their homes, which is right now very unpopular. For homeowners, it is still a far superior alternative to foreclosure as it avoids the dreaded F word reported to the credit bureaus. Typically, borrowers suffer a credit decline due to the late or missed mortgage payments, but it's not nearly the problem that a foreclosure is. Now, foreclosure itself is the last resort. When all else fails, it's the remedy that lenders may exercise, legally taking the property away from you. Homeowners can pretty easily avoid it in most cases, and I sure advise you to do so. Now, learn more about my story and more about mortgage workouts by listening to a free CD I put together called 60-Minute Loan Modification Secrets. You get it at 60minuteloanmodification.com.